Hello everyone, and thank you for joining us for this Have You Thought About Setting Up Your Own Accountancy Practice webinar. We're delighted to be joined today by Stuart and Fiona from Walls Training to present this webinar. Before I hand over to Stuart and Fiona, there are just a few points I'd like to make. To minimise disruption, you have all been automatically muted. If you have any questions, please enter them in the questions box, as there'll be a short Q&A session at the end of the webinar. If we do not get time to answer your questions, you'll be contacted afterwards. And following the session, you'll be sent a copy of the presentation slides and a recording of the webinar. Without further ado, I'll hand over to Stuart and Fiona.
Hello there, it's Stuart here, as you've probably gathered. Thanks everyone for attending. I'm Stuart Ferguson. I'm joined by my colleague and co-presenter Fiona Jones. I'll be talking a little bit more about Fiona later. But I'd just like to say the inspiration for this course was that after about 10 years in practice, I felt looking back that if I'd known at that stage what I knew when I started, I felt that the practice would have progressed a lot quicker and been a lot further down the road. So that was really the inspiration for writing this course. So normally we have a one-day intensive training course. But this is really just a summary or an outline of the course. We only have an hour, so there's only a limit to what we can put in. But the course is essentially divided into two sections. There's the technical skills, which to a large extent are the tax skills that you need if you're setting the basic tax skills that you need to set up in practice. And then there's the practice management skills. And effectively that comes down to how to make money out of clients. If you are interested in taking this further, actually, we will be giving details of our full day intensive course at the end. I just wanted to say a little bit more about Fiona. Fiona started her practice about 10 years ago, and Fiona is actually based in Camberley. I'm based in central Scotland. We're both SEMA members, but Fiona is also a chartered tax advisor. Fiona?
Yes.
Okay, that's it. Okay. We're going to the next slide. Okay. Really, this slide is really just giving you a basic outline of the skills that you need. These skills are on the course, actually, the skills that you need when you're setting up in practice, actually. So from a technical point of view, if you're a SEMA member, you obviously want to know about the SEMA regulations and how to make sure that you are not out with the regulations. There is also a little bit, not strictly speaking, technical guidance about practice structures. So that's bridging the income gap, and that's really essentially if you're on, say, 70,000 pounds a year, you can't really expect to throw that job in and set up in practice and earn that sort of money until several years down the line. So we look at various ways of bridging that income gap. There's also the basis of assessment, which will come to, it won't mean much to you at the moment, but I'll talk about that later. We talk about capital allowances. We also briefly touch on losses. On the course, we also talk about allowable expenses. It's obviously important that you know, if a client comes to you, obviously important that you know what expenses are allowable and what expenses are not allowable. We talk about payments on account. Filing deadlines, and then there's also quite a bit on incorporated companies. So really, these are the basic skills that you need in order to set up in practice. Later on, the second part of the course is what's called the practice management guidance. We'll, for example, show you where to find specialist support, because you're never going to know it all. You're always going to have that 5% where you need to go to a specialist. We talk about advertising and marketing. We talk about how to price your services. What to do when you get a client, and software and the different types of software you need for different types of services that you offer. Yeah.
Right, so if we look at the professional requirements from a SEMA perspective, first of all, so we need to comply with the Institute regulations, and Council regulations state that members must conduct themselves in accordance with the laws of the Institute. You also need, when you apply to become a member in practice, to hold an appropriate level of professional indemnity insurance, and you need to have evidence of the various bits of paperwork in place. So, for example, we need to have engagement letters with our clients. These are similar to contracts, and they will outline the scope of the work that we're going to do for the client. They also outline what our responsibilities are to the client and what the client's responsibilities are. We also have to have a very good awareness of money laundering regulations, and we need to be able to know what needs to be done when we take on a client with regards to complying with money laundering regulations. We also need to have a continuity agreement with a fellow practitioner. This might be another accountant in the same area, or they might not be in the same area, they could be miles away. But it's a good idea to have an agreement in place with an accountant who will be able to step in and manage your practice in the event that you are very ill or incapacitated, or if something happens to you and you die. The other thing that you need to provide evidence of is that you have a proper complaints procedure in place. So you have a responsibility to address clients' complaints when they're unhappy about your service. You also need to make sure that they're aware that if they need to, they can actually complain direct to CIMA. So we have to prove that we have a procedure in place to deal with those complaints if and when they happen. You also need to carry on with your CPD professional development cycle, although obviously it might be aimed at different sort of development if you're moving into practice. Very often we're asked whether do we really need to sign up as a member in practice. Well, actually, yes, you do. As long as you're providing an accounting service as defined by the Institute regulations, then you will have to register as a member in practice. So moving on to practice structure. During the course, we look at how to structure your practice and how to kick it off, if you like. So first of all, we look at bridging the income gap. Now, you'll find that when you first start, that you may come out of industry, so you may be used to quite a nice high salary, and then all of a sudden you start your own practice, and unless you have a lot of clients right from day one, your income is going to drop quite significantly. And what you can do in order to bridge that gap is, for example, to carry on in full-time employment, but build up an accounting practice on the side. You could also give yourself a bit more flexibility and do contract work, so that you can effectively take time off the contract work in order to build up your practice or to visit clients or prospective clients. You might also want to work part-time as a way of giving yourself a bit more income. When buying a practice, you can actually go to an agency. You can actually approach different accountancy practices and ask them if they want to sell off a block of fees or a book of clients. Very often accountancy practices might have made a strategic decision to specialise in a particular area, in which case they may want to sell off the clients that don't fit into that niche. We also look at franchising and what the basics are with regards to franchising. That can be a good way of building up a practice, but it can also be quite expensive because you have to pay a fixed fee up front in order to join the franchise and to buy your area, and then you might have to give over a percentage of your fees each time you receive any income. So what do you need to know, Stuart?
Yes, I mean, what you might be surprised to know is that in practice, really about 95% of your clients are fairly routine. And essentially what you'll get, not necessarily, this is only a summary of the course because it's only an hour, but certainly what we do on the one-day transition courses, we believe really that's really all you need to actually get started. So we go over actually what you need technically in order to start. We'll also give you a brief overview of the tax system. And there's 4 main categories of income, and each category may attract a different rate. So it's important to know which categories of income to put first. For example, you know, obviously we prefer if your highest tax category was put down first and got set off against your personal allowance, but unfortunately there's certain rules they've got to follow in actual fact. So we do have a look at that. And we also have a look at something called the overlap rules. Now, I'll just talk about the overlap rules here for a minute, actually, okay. Now, the overlap rules, this is again one of the technical areas. This applies to self-employed people and partnerships. It's a different set of rules for limited companies. Now, if we take, for example, an accounting period, which you're all familiar with, that's the period that accounts are drawn up, and that's normally annually. But the basis period is used to calculate the tax liability. That's the period that goes into your tax return. So when you start trading, and a lot of people find this a little bit confusing, when somebody starts trading and they're a sole trader or partnership, the period that goes into your first tax return is from when you start trading to the following 5th of April. So if you started trading, for example, in December, what would go into your first tax return would be from December to the following 5th of April. Okay. Now, what goes into your next year's tax return? So what goes into tax return for the subsequent 5th of April? That is actually the first full year's trading. So on your second year's tax return, you actually have a slight overlap from year 1. And we deal with this, because this is just an outline and a summary, we deal with this in more detail, but it's actually relatively easy to understand once you've done a number of examples. And after year 3, you go on to what's called a current year basis, and that's the tax year in which the accounting period ends. In other words, even in year 3, you don't prorata it over a tax year, over the end of the tax year. It's the tax year in which the accounting period ends. All of your profits go into that. We can have a look at that in a little bit more detail on this slide. A. McClay starts trading on the 1st of October 2007 and draws up his accounts annually. What will be his basis period for the first 3 years? Well, year 1, as I say, it's from when he starts to the following 5th of April. So it's from the 1st of October to the following 5th of April. Year 2 is the first 12 months trading. So again, it's from the 1st of October again to the 30th of September. And then year 3 is the normal rules, i.e. the tax year in which the accounting year ends actually. So these are the sort of technical things that you need to know to serve in practice. And when you first get taught them, they do come at you as if there's an awful lot to learn, but really there's not that much to learn in actual fact. You'd be quite surprised. Okay. Another thing we have a look at are capital allowances. Now, capital allowances, a lot of CIMAs these days don't really come across capital allowances much. The reason being that it's not the tax for large companies tends to get outsourced, or they have a specialist in the company. But capital allowances tends to be one of these areas where you know, what you learn in about 40 minutes will do you as far as most clients are concerned. They're fairly straightforward. And capital allowances essentially are the ways that HMRC standardise the rules for depreciation. And now there are different rules according to the type of asset and the business structure. The rules can change every year. And there's also a question, because you're sometimes dealing with sole traders and partnerships, how do you treat private use? And how do you treat disposal of assets? So if we have a look at an example, here we have, if a trader buys the following assets during the year, 6 months into the financial year, he buys a car for £9,000 and it's 20% private use. And 9 months into the year, he buys plant for £18,000. Calculate the total writing down allowance for the year. Now, if you ignore something, because we've only got an hour here, if you ignore something called the annual investment allowance, which we don't cover here, what will be the values of the respective capital allowance pools at the end of the year? Well, if you want to, we'll go to the answer actually. Okay. Right, so note the car has a private use element, and any asset which has a private use element, that must be kept in a separate pool. So when you look at this car, I should also say that the writing down allowances vary, but they're pretty much standardized over the last number of years at 18%. So if you have a car valued at £9,000, you take 18% of it, 1620, you then must adjust for the personal allowance of 20%. So you've got a capital allowance of 1296, and the balance you carry forward is the £9,000 less the 1620. So the balance you carry forward to the next year, which is unused capital allowances, is 7380. Okay, so the next year you've got that balance, you can then take 18% of it and then deduct the 20%. And with the plant, because there's no private use, you simply take 18% of the 18,000. And another point worth noting is that although you may be buying these assets partway through the year, you're still entitled to take a full year's capital allowances. So it doesn't matter whether you buy an asset at the start of the year or at the end of the year, you can still claim a full year's capital allowances. Okay, have a look at the next one. These are some expenses. I've classified them as tricky expenses. Whether that's the correct category, I'm not sure, but it's ones that often raise concerns actually. So we go over home office expenses. Now, home office expenses essentially relate to the reimbursement of costs of people when they're working from home. And they can be applied to a sole trader or a limited company. And there's different rates depending on the amount of time and that you spend at home. And also, if you're a limited company, effectively, you get a round sum of allowance of about £200. The apportionment of car can sometimes cause a bit of an issue, but generally speaking, you've got a choice of two types. You can do the fixed profit mileage expense allowance, where essentially it's you get 45 pence for the first 10,000 miles, and then 45 for the first 10,000 miles, and then for the remainder is 25 pence.
Yeah.
25 pence. Sorry. Some of these things you forget that and heat of the moment. Okay. But anyway, you've got the choice of doing the fixed profit mileage allowance, or you can actually do an apportionment. And generally speaking, the inland revenue, in my experience, if the apportionment seems reasonable, then they will generally accept that actually. But you should always advise your client that they may be required to produce backup documents to substantiate that. But really, in my experience, unless people start putting down 90–95%, and generally speaking, the inland revenue don't pay too much interest. But you know, it's up to really you to tell the client what he needs to do. Actually, the records he needs to keep. Actually, okay. Okay, I'll hand back to Fiona, who's going to take you some deadlines.
Okay, so important deadlines for sole traders, or self-assessment. So these will be self-employed people or people operating through partnerships. So the self-assessment deadline relates to the tax year. So the tax year in the UK runs from the 6th of April to the following 5th of April. So for 2019-20, the tax year runs from the 6th of April 2019 to the 5th of April 2020. The tax return and the tax due is due by the 31st of January following the end of the tax year. So for 1920, the tax return deadline is the 31st of January 2021. And the client must pay his tax by then as well. So if the client is has a tax bill of more than £1,000 and pays less than 80% of his tax each year through PAYE, then he will have to make payments on account for the following year. So payments on account are payments that are made for the following year, for 2020, 2021 in this case. These interim payments are due in 2 equal instalments on the 31st of January and the 31st of July. And it's based on the previous year's tax liability. The final settlement will be of the tax due will be paid on the following 31st of January. So if for 1920 the tax bill is £10,000, the client will have to pay £10,000 by the 31st of January 2021, but they will also have to make payments on account for the 2020-2021 tax year of £5,000 each on the 31st of January 2021 and the 31st of July 2021. So we cover that in more detail, obviously, on the course. If the tax return is submitted late, then there is an automatic penalty of £100 for the first 3 months, and then over those 3 months, the penalties rise. You'll also have to pay interest on any overdue taxation as well. So moving on to limited companies, we also look at compliance deadlines, fundamental tax planning for directors, dividend rules, and directors' loan accounts. So for a limited company, the main deadlines are for submission of accounts to Companies House will be within 9 months of the accounting period end date. So for a limited company whose accounting period ends on the 31st of March, they will have to get their accounts into Companies House by the 31st of December following. HMRC require accounts to be sent to them in the full version and in an IXBRL format. So you will need specialist software to do this. It will need to be attached to the tax return or the corporation tax return, and payment of corporation tax is due within 9 months of the accounting period end. The actual corporation tax return isn't due until 12 months after the year end, but we tend to do everything all at once and do it 9 months after the year end so it doesn't get forgotten. Now, there is some tax planning that you can do for directors, which means that they can take advantage of the dividends as opposed to paying themselves a salary. So we find that there is a good mix of paying them a low salary and the rest of the money they take in dividends. So they will generally pay themselves up to the NI threshold and then take the rest in dividends. And then that way they don't have to pay any tax on their salary or any national insurance, because dividends are paid without having to pay national insurance. Dividends are taxed at a much lower rate than salary, and you'll find that the first £2,000 of dividends are tax-free. Anything falling in the basic rate band is taxed at 7.5%, and then higher rate band is 32.5%, and then the advanced rate band is 38.1%. So you can see it's much more tax efficient than paying the director a salary. There are rules, however, for taking a dividend out of a company. The company must have sufficient retained earnings after allowing for corporation tax before the dividend can be paid. The director must also complete a dividend voucher before making any payments as well. So you need to have in place the management accounts so that the director knows whether or not they can take a dividend. There are 3 different types of dividend that they can take. They can take a final dividend, which means that it's declared on the year-end company accounts. They can make interim payments throughout the year, or very often what will happen is that they will take an advance on dividend, and that would get put to their director's loan account until they declare the dividend properly. Director's loan accounts you have to be very careful about, because if the director's loan account is overdrawn, then the company will suffer what's known as Section 455 tax, which is at a rate of 32.5% of the overdrawn amount. This will kick in if the overdrawn director's loan account isn't repaid within 9 months of the year end. So we now look at different business structures. And as I say, this is just a summary of what we're going to look at, but obviously on the course we go into far more detail. So
it's it's a very worthwhile part of this actually, because you could have a client coming to you starting up and wanting advice from you as to whether it's better to set up as a sole trader or a limited company. Or it could be as a situation that I have at the moment where a sole trader has reached a position where from a tax point of view is actually better to convert to a limited company. So anyway, sorry to interrupt.
That's okay. Yes. So I think you've gathered that there is a very different structure between sole trader or partnerships and limited companies. And there's also quite a lot of compliance put onto limited companies, which means that their admin costs are going to be far higher than if you were to operate as a sole trader. So if we look at this table, it's a bit busy, I'm afraid. I hope you can see it. This looks at the comparison of if you were to operate as a sole trader, as opposed to if you were to operate through a company and pay personal tax on anything you take out of the company. So this is for the 1920 tax year. It assumes that if you were to operate as a company, that the director would take a minimum salary of £8,632, which is up to the secondary NI threshold, and so they won't pay any national insurance or any tax on that salary, but the rest of the profit they might take out as dividends. Whereas a sole trader will be taxed on all of the profit and will have to pay Class 4 and Class 2 NIC. So if we look at the first line, we have £15,000 worth of profits, and on which the sole trader tax would be £1,229. The company, if that person were to set up a company and become a director and pay personal tax on his salary and dividends, then they would only pay £1,209 company and personal tax together. So you can see at that point there's not much of a savings. It's only about 19 quid. So as we work down the profits, you can see that at £45,000 it starts to make more sense to incorporate the business. So the sole trader tax on £45,000 profit would be £9,929, whereas if you were to operate through a limited company, the profits would be £8,679, a saving of almost £1,250. Now that's going to cover any additional admin costs or accountancy fees that you would need in order to run a limited company. So it's useful to know this sort of thing, and you can work through the figures with the clients and find the optimum point at which they would incorporate their business.
Okay, I'm just going to add to that, Fiona, thanks very much. I'm just going to add to that, the figures that Fiona's quoting are for England and Wales. There are slightly different figures, tax rates applicable to Scotland actually. But I just thought I'd put that proviso in there. That's because there's quite a lot of people watching. There will be a number of you who are setting up will be in Scotland actually. Anyway, we move on to VAT. We don't cover VAT in any great depth actually in the course, but there's a few areas that it's worth knowing. One is registration. I mean, I know many of you will actually be quite familiar with how VAT works, but some of the items that we're showing here you might not be particularly familiar with. So with registration, there's a threshold of 85,000. So if your taxable supplies exceed 85,000, then you have no option but to register for VAT. Okay, you can register voluntarily if your turnover is below that, and you may, for example, have a client who's a builder whose customers are all VAT registered. So it may be in his interest to register voluntarily, because he will in that case be able to claim back the VAT in his inputs, but it won't affect his sales. There's also pre-registration VAT. So if you register a VAT, you can generally go back, or you can go back 6 months and claim VAT on services prior to your registration date, and you can claim 4 years and effectively on any stock items that you have and still have on the premises. The threshold is actually on a rolling basis, so it's not on a financial basis, a year-end basis, and it's not on a tax year basis. It's on a rolling basis. So if a client is getting near the threshold of 85,000, you should advise him that every month he should have a look at his VAT turnover to see if he needs to register for VAT, to see if he exceeds the 85,000. There's also, most of you are probably also familiar with what's called the accrual scheme for VAT. And on the accrual scheme, the tax point for an invoice is the tax point on the date of an invoice. However, if a turnover is below of 1.35 million, you can actually register for what's called the cash-based scheme. And with the cash-based scheme, the tax point is when you either pay the money or you receive the money into your bank account. So in these cases where people have debtors are higher than the creditors, it's always better to register for the cash-based accounting scheme. We also mentioned something on the course called business splitting, which is essentially where someone wants to keep the turnover below the VAT threshold, so they try to split their business actually, and normally it's quite unsuccessfully. So we do mention the pitfalls of people trying to do business split and how the revenue will try to interpret that. Okay. Now, practice management. During the course, we give a demonstration of practice management software. So we give a practice, and we also give a demonstration of tax software. We were thinking about giving a demonstration of the course because it is a very effective demonstration, but unfortunately, it was just going to take too long. But there's certainly a number of specialist softwares out there, which basically all accountants now use in order to collate tax returns and collate the trial balance, put it into a tax return, and send that off to the inland revenue. So essentially what you're doing is, as long as your trial balance is okay, you press a button, you then get a set of accounts, you send them to your client. If he's happy with them, you spend another one and you send them off to the inland revenue. So we talk about the different types of software on the course, but it's also worth knowing you probably also need to buy bookkeeping software as well as tax software. So again, there's more than one type of software you've got to look at. Where to find specialist support? There are helplines out there. So you can register with a helpline, and we go over the various types. For example, some of them you might pay £50 a month, and that might entitle you to 10 phone calls a year, etc. There's various websites where you can get help, and we also recommend particular manuals which we find are easier to use than others. We also suggest areas where you can increase your tax knowledge, because obviously if you come on this one-day course, you might say, well, that's all very well, but I really feel I would benefit from getting a bit more in-depth knowledge. So we suggest areas where you might want to go and increase your tax knowledge. We look at advertising and marketing. Advertising and marketing, we'll have a little look at that in a second, but that's one of the most important areas in setting up your practice, and it's one that's often neglected. Because what happens is that people, they get rid of the spare beds and the beds from the spare bedroom and put in a desk. They get someone to write a website for them, and they think that they can just sit back and the money will come in. Well, that's not the case. It's a very active, proactive. You've got to be proactive in order to make people aware that you are now out there and you are an accountant, actually. So that's something we do cover in quite a bit of depth, and it's something that traditionally people feel they get a good benefit from. We also cover how to price your service. Again, we'll be covering that slightly here, and also we cover what to do when you get a client. There's certain things that you must do when you get a client to make sure that you are within the Institute regulations. Okay. So if we have a look at mainstream advertising, these are probably the 4 areas that people concentrate, accountants tend to concentrate on. There's the website, which is effectively your traditional website, and we do talk about ways how you can spend more money to get it further up the website. Also, we talk about networking. Now, networking, it tends to be very useful if you're on a budget and are looking to build a business up slowly. It's not something where you're going to suddenly get a big increase in clients, but again, if you're on a budget, then it is a very good way of increasing your turnover. Okay.
And also there's social media. That is another form of networking as well, isn't it?
And that's probably becoming more important, actually.
Absolutely, yes.
My personal favourite, and people think that I'm off my head when I talk about this, my personal favourite, and it's always worked the best for me, is mail shots. And I do a demonstration on the course, actually, how you can get software, very cheap software. You can go into, for example, if you lived in Colchester, you could interpret this, you can get this software, you can go into it, interrogate it. You can find every business that's set up in Colchester in the last 2 years, and many of them will not have an accountant. So you can actually download it and do a mail shot to them, and you can also target specific industries. The other thing, you can register with certain companies who will actually send you a list of all limited companies that are set up in a particular area. So suddenly you have this information, you suddenly know that in Colchester you get a list every month from a company of, say, I don't know, say 12 or 14 companies that have just recently set up, and many of them will be looking for accountants. So we go over that on the course, actually, in more detail. We also talk about telesales. Both myself and Fiona have used telesales a couple of times, and with varying degrees of success. So we talk about our experiences with telesales, but again, I always say to people, advertising is one of the keys to getting your business off the ground. Actually, advertising and also networking actually is the keys to getting your business off the ground. Okay, and what we also talk about, an area that's always people are always very interested in, how to price your business. Okay, how to price the work that you're doing. If someone comes to you, how do you quote for it? One of the first things to decide is timesheets or not timesheets. That is the question. That was supposed to be a bit of humour. But anyway, it's always a debate between accountants whether they should have timesheets or not. And there's also 2 particular ways that you can price, actually. I tend to be quite traditional, and I keep timesheets, and I base my pricing on an hourly basis. Now, I don't always necessarily charge the same rate, but I always keep a note of what we should be charging them. Sometimes we'll charge them a little bit less, and sometimes perhaps I might even charge them a little bit more if we think that it's a higher quality work. And Fiona, you actually have a different method. You use this very fashionable value basis pricing, don't you? You were talking about.
Yes. Yes, I mean, the logic behind value-based is that we try to add more value to the package that we're offering to the client. The theory behind it is that automation and cloud accounting solutions have reduced the time taken to actually do the work. Turnover is therefore set to decline if you're pricing purely by the hour, and your overheads, of course, will always go up. So we like to focus more on value and what we can actually deliver to the client. But in order to do that, you have to actually sit down with the client and find out where the pain points are, what their problems are, because the solution that will be valuable to them will be the one that helps address their problems and solves their problems. You can't do that over the phone. You very often find that you'll get somebody who picks up your number off your website, phones you up and say, how much to do a limited set of accounts? And they will always say, oh, but they're very straightforward. Well, nothing's straightforward, believe me. And it's only when you actually sit down with the client or the prospect and discuss what they value and what they need a solution for, do you understand how you can help them with your service. So customers generally want certainty. They want to know, they want a fixed price. They don't want any surprise bills. They want to have a choice. So generally, marketing research has found that people like 3 choices. And if you give them 3 choices, they tend to go for the middle option because it's usually the safest. So we like to give them a choice of packages, but we use pricing software so that we can actually tweak those packages to address their pain points and make sure that it's the answer to their dreams, if you like. So that is the theory behind our value-based approach. And I think that is bringing us towards the end of the webinar, but back over to you, Stuart.
Yes, I'm just putting a summary here. There's a lot in the course, actually. Obviously, we've just given you an outline of it today, but I think it's important to keep focused. And if you're wanting to have a profitable accountancy practice, it basically boils down to gaining clients, and you can effectively say, well, that's through the advertising and marketing element and the networking element and the reputation element. It boils down to keeping clients. A lot of that's to do with making sure you're doing the correct job, making sure you're up to date with the tax, and you're processing everything correctly. And the other thing is to do with making sure that you manage clients in a profitable way. There's no shortage of accountants out there that actually are very busy but don't make any money. And I think the other thing that I should add to that is that one good thing about keeping timesheets is that you really want to manage it such that you are billing out about 1,200 hours a year. Because many of you will be in jobs where effectively you're perhaps doing 35 hours a week, and you will get paid for this 35 hours a week, irrespective of what you're doing. But I think it's important to realise that in practice, when you set your pricing, you've probably got to appreciate there's probably only about 25 hours a week, generally speaking, that you can bill out for. So you've got to build that into your pricing structure. Okay. Now, that was basically the outline of the course, actually, and I hope that's been beneficial to you, actually. Just to say, this is a very much an outline, so summary of what we do. There are courses that we have now set up if you want to go on the 1-day intensive course. There's 4 dates there. Remember, they're all 1-day courses. So there's London, Manchester, and Birmingham. We would say it depends to a certain extent on the number of people that we get. So that's why we haven't actually decided on the actual venues yet. Actually, we'll just see what the feedback is. Actually, in fact, we should also mention that you can get details of how to book from our website www.walshtraining.co.uk. We'd also say, just to add to that, we do also run a sort of secondary course called the Practice Progression Programme, because what we're finding is that people were coming on the transition course, and what they were finding, they really were a bit hesitant about going into practice because they were a bit scared that they'd make an enormous mess up. So what we do is we have this practice progression online mentoring, but effectively what we do is we have a session of 1.5 hours per month, and it's online and it's on the evening. And so what we do is effectively we send out to all intents and purposes accounts that come into our practices. Now we doctor the figures and we change all the names, blah blah blah. So it's obviously made up to a certain extent. But we send you these figures, and then we ask you to do a set of accounts and calculate the tax returns, and then we go over the results each month. And you'll be very surprised how quickly people progress, because you were getting people that say on the course were giving answers which were incorrect to basic questions, and then 2 or 3 weeks, 2 or 3 months down the line in the practice progression course, they were actually getting tired of getting questions because they were actually finding them quite easy. So that's just something to have a think about, actually. So I think that's the allotted time up. So we have left time for questions. So I don't know if Emma, you want to come in here at this stage?
Yeah, absolutely. So we've had a number of questions. Quite a few of the questions related to the dates and locations of the course, which I think is probably answered by this slide. Of course, the link that Stuart shared at the bottom will be available in the feedback email as well that we send this afternoon. So any I guess any more inquiries can go through there. But we have had a few more specific questions asking around if you will also look to open up the course to even going up further north to Scotland and further south as well in the UK. And a lot of questions are coming around whether there's any particular qualifications to do with tax that you would recommend as part of the course. Whether there's additional tax qualifications that members should be looking at before going into their own practice.
Well, if I deal with the tax one first, actually, there's a number of things you can do. I don't think that I would. The slight problem you have with doing the tax courses is that you've almost got to do a tax qualification to do that, and a lot of the tax qualifications will involve tests. Well, firstly, you don't necessarily want to do a tax qualification because you've already done 3 or 4 years of SEMA. But a lot of the tax qualifications, in order to pass them, they relate to items in reality you never really come across in practice, things like trusts and overseas and these sort of things, actually. But in reality, it's better to use an expert. But I would suggest possibly is the ACCA tax module. So that's the ACCA tax module. You can actually buy the book and work your way through the book. And I think it's quite possible, it certainly was possible. What I did was I just went to a local college which was teaching ACCA, and I went along on that day when they were doing the ACCA tax, and I actually just went in and attended the course. So I didn't sit any exams, I just went and attended the course and got the knowledge, got some increased knowledge through that. But I think if you were to do a course, you'd probably suggest the Institute of was it ATT?
Yes, I mean this is where the course is quite fun, actually, because Stuart and I don't often agree, do we? So we argue. But yes, I mean I qualified as a chartered tax advisor because I took one look at my first tax return and I thought, my goodness, I could get sued. So I did the Chartered Tax Advisors exams, and I probably would have been better doing the Association of Tax Technicians, ATT, because CTA is very, very detailed. It's very interesting if you like that sort of thing, but it goes into a lot of detail about trusts and inheritance tax and that sort of stuff, which is great. But in general practice, I haven't actually used that level or that depth of knowledge, although it did give me a certain level of confidence. ATT is much more in line with what we tend to face in general practice and is probably a bit more appropriate. And so from that point of view, so I don't regret having done CTA, but looking back, I wish I'd done ATT.
Yeah, there is another possible option, and that is that colleagues do online modules, and it might be quite a good idea to register for some of the tools. If you actually go into the practice progression program, you actually we've got a deal with them where you get a discount. The only problem is he tries to sell you all 12 modules, but I tell people no, there's only 3 modules you need to buy at this stage. So I think the Tolley's modules, I can't quite remember the price of them, but they're not. I think they're about £200. It could be around about £200 a module. That's quite a good course actually to go on. As I say, there's about 12 modules, but you really only want to. It's not a qualification, but you're really only wanting to have a look at the 3 modules actually. And again, with the ATT, I don't think there's anything to stop you registering with the ATT and just going along to either not registering or just going along to the college or registering with them and just going along to the sections where they're going to be teaching the areas that are going to be relevant. You know, as I say, there's a great deal of it really is not relevant. The overseas you'll probably never deal with. The unit trusts you'll probably never deal with. There's a whole chances of it, and you'd be quite surprised at how little the area that you will be doing 95% of your time will be spent in. Does that help answer that question?
Yes.
Okay. The other question about location. We've tried to be quite conservative. We used to do a great deal more courses actually, and then the way the advertising changed, and we continued with that, but unfortunately we weren't getting the flow through. So we've tried to keep it to a number that are reasonably confident will be successful. But if people are, what we might look at doing, if people are interested in courses north of Manchester, if the numbers were there, then that was something we'd be looking at. But I think to get to that, we'd probably be looking about between sort of 7 and 10 to make it worthwhile. Actually, that sort of number, and it'd probably be a mix of Scotland and say the northeast of England, that sort of thing. Actually, does that help answer that question?
Yes, absolutely. We've had another question from Richard asking, do you need to renew the continuity agreement each year?
No, you don't. I mean, you tend to set one up with somebody that you know and trust. And I've had my continuity partner since I started, which was 14 years ago, and we both started at the same time. Funnily enough, we met on a course like this one. You know, on how to set up your accounting practice, and we now meet on a regular basis, and so that we're also very familiar with how each other's practices have developed as well. But no, you don't need to actually renew the agreement each year. When you apply to be a member in practice, and when you renew it, you then have to fill in the name of your continuity partner, but you don't have to actually renew the agreement, do you? So, any more?
And another question that's coming from Lena is it advisable to start taking on clients before you've completed your SEMA journey, or is it better to do this once you're fully qualified?
We can only register. I think you can only register as a member in practice if you are fully qualified. I think.
Yes, I think so.
Yeah.
The other thing I think you've got to be careful of is what the requirements of your professional indemnity insurance might be as well, because they may insist that you have a relevant full qualification. So I would just be a bit careful.
Yeah. I mean, in order to use the SEMA name and register under SEMA, you need to be SEMA qualified. I mean, there are accounts. I don't know what the situation would be if you set up and didn't advertise as SEMA. I don't know the answer to that one. Actually, in fact, yeah.
Okay.
And another question that's come in from Ralph is asking whether your venture into private practice has been profitable. He's thinking about the opportunity of cost of leaving the industry, and yeah, has asked how profitable your experiences have been.
That's an interesting
one. Yes, I mean, I've got kind of sort of quite an interest in Johnny, because it's very rare that I actually have worked full time in the practice. I really started it up as a sideline to doing contract work, and then it built up on its own. And I now run it. Really, I probably go in there about 1 day a week, and I think it's going to be an income. A profit should be about 30,000 this year. So you've got to add that, and that's for 1 day a week. So you've got to add that to my sort of freelance work. So yes, it has. I mean, there's different business models. I mean, my particular business model I call it's a sausage factory, and it's a very straightforward. A lot of it's not particularly complicated and can be done with unqualified staff. Whereas Fiona's business is quite a different model, isn't it?
Yes, I mean, I tend to go for the sort of added value area and try to work with the clients on a monthly or a quarterly basis to help them grow their business. And one of my larger clients, I might charge in the region of £25,000 a year just for that one client. But then I'm doing a lot of work with them and helping to grow their business. So you do have to be careful about when you take on a client, not to be too enthusiastic to take everybody on who you possibly can. You've got to be choosy and not just take on somebody who may not be may be operating at a very breadline level themselves, because if you go for people who are very price sensitive, then they are going to whinge every time you put your bills up each year and every time your prices go up. They won't value whatever it is you're trying to do for them either, because all they're thinking about is that you're a cost, you're an overhead. So a lot of it is down to being able to pick the right sort of clients and having the courage to turn away the clients who are going to be very time consuming and who will basically operate at a loss. So you do have to be very careful, and it's down to how you
manage it. And I should say that there's different business models. I mean, at the moment, the question sort of implies that you're moving from a full-time job to a high street accounting practice, taking a lot of clients. But remember, there's lots of sort of in-betweens. You know, there's quite a lot of accountants will go into a company 1 week a month, or perhaps several, a couple of companies 1 week a month, etc. So that sort of thing is almost a sort of in between. So you're building up a client base, but you've also got these two big clients which you're getting regular income from.
And there's other approaches you can take. Like, for example, I would recommend not to do the bookkeeping yourself, to either hire a bookkeeper or subcontract the bookkeeping to somebody else who will do it, because for your qualifications you want to be charging a lot more for your time, and if your time is being sucked up doing bookkeeping, which you can really only realistically charge a much lower rate to, it makes far more sense to outsource that and then to focus on the areas where you can charge more for your skills. And then, you know, it's about really making sure that you focus your efforts in the right area and at the right pricing.
You certainly feel a bit more freedom, I think, if you're sort of self-employed, actually, not tied down.
Yes, yeah. Any more questions?
Yeah, with talking about pricing, we've been asked a couple of times what pricing software you would recommend to use for value-based pricing.
Okay. Well, there are quite a few packages out there. I've used quite a few, I have to say. Mark Wickersham is a bit of a pricing guru, and he writes a lot about accountants, pricing for accountants and that sort of thing. He has actually developed his own pricing mentoring course, and he also has pricing software which he sells separately as well. But you can, when you're first starting out, you can actually develop your own spreadsheet, which will do the job just as well. The nice thing about having some sort of pricing software or some sort of pricing spreadsheet is that it makes you look so much better in the meeting with the prospect, because if the prospect turns around and says, I can't afford that, the temptation, if you don't have a method that you're working to, the temptation is to turn around and say, oh, okay, I'll knock 20% off, or I'll knock 10% off. And at that point, you lose all credibility, because the prospect then thinks, oh, okay, I'll push for a bit more, or maybe they're just overcharging me. Whereas if you have some sort of pricing methodology that you work through, if they get to the end and they say, wow, that's a lot of money, you can then turn around and say, okay, what do you want to take out of the basket? What do you not want us to do? What would you like to give up? Because actually, with it being a collaborative process, by them going through the pricing with you and putting things in and out of the basket, they're already buying in to actually sign up with you. So if they then say, well, it's too expensive, you say, well, okay, what do you want to take out the basket? And that has a much more professional, and it doesn't look like you're sticking your finger in the air and just guessing. So That's the approach that I tend to take.
I mean, also, I don't use pricing software. I just have an hourly rate and timesheets. But most accounting packages or tax packages, and not as opposed to bookkeeping packages, will have a facility where you can put the hours in. So if you mean by pricing software, if you mean something like price recording, putting the pricing in, then most, as opposed to actually quoting for a price, then most tax packages will have something that will do the job for you.
Okay. So I think
brilliant. Yeah, I think that takes us towards the end of our question and answers. So for everyone that's attending, thank you very much for coming along today. I've just put up a short poll to see if you'd like to receive any more information about the course from Fiona and Stuart as well. Just to remind you that we'll send out an email this afternoon, and that will have links to the website that Stuart just put up on that last slide, and also a feedback survey. We'd really value any feedback that you can provide. We'll also send out a copy of the slides and recording this afternoon. It should be about 4 o'clock. Thank you very much, everybody, for coming, and thank you, Fiona and Stuart, for speaking. Enjoy the rest of your day.
Yeah, if I could just quickly say, there's a facility on the website to make a discovery call. So if you can't make one of the advertised courses, you could always give me a call and try and put your name on a list, and I could see if we got enough numbers, I could see whether I might do a course out with the ones advertised.
That's good.
Okay.
Brilliant.
Yeah. Okay.
Fantastic.
Thanks very much, everybody.
Brilliant. Thank you very much, everybody. Take care.
Bye.
Bye.
Oh, I got